Yeah, Jeff, I just want to push back against something you said, not because I think you're wrong, but I want you to clarify it. You point out that it would be impossible for retail investors to force a squeeze in something like silver and the differences between cornering a commodity versus squeezing a stock. But I remember 10 years ago, there was a moment when GLD, the gold ETF, had more assets in it in dollar terms than the SPY. And I do think that GLD was moving the price of gold. I can imagine a similar situation with silver and the silver ETF if people get excited enough about it, where what happens in the markets ends up influencing what happens with the actual metal in real life. You're saying you don't think that that's a possibility?
I mean, you're talking 900 million ounces in the ETF versus a 25 billion ounce market. And by the way,
But
the
those
silver
billion ounces
market,
don't move.
but the silver
They
market,
just
and then
sit.
you go on.
They
But
just
I think
sit. Those other ounces just sit. They don't move.
right, but the vast, I mean, you look at the flows going in and out of these ETFs, they're not that big. But I guess my question is, forget the ETF. In terms of thinking about how are you going to create a squeeze, the shorts are the ETFs. The ETFs buy the physical, they turn around and they sell on the COMEX to be able to hedge that physical position like any other corporate.
So Mr. Curry, Goldman Sachs, want us all to move along. Nothing to see here. It's impossible to squeeze the COMEX silver shorts. But the reason that he provides is a shocking admission, really, as to the fraud that's ongoing in the silver market and has been going on for years. And Mr. Curry has let the cat out of the bag here with this one. What he basically is saying that the big COMEX shorts are the ETFs. And whenever we think about what that really means, is that the ETF custodian banks, who should be holding physical metal for the most part, for those full, physical ETFs, those banks are trading the metal like it's their own and placing a corresponding short position, a hedge on the COMEX, according to Mr. Curry. Now, that metal in the ETF does not belong to the custodian banks. They are holding that metal on behalf of the ETF investor. The ETF investor owns that metal, so the bank should not be placing any corresponding short hedge. There is nothing to hedge, it's not their metal. In other words, Mr. Curry is admitting that ETFs and the custodian banks that engage in this behaviour, the shorting behaviour on the COMEX as an apparent hedge, these ETFs then are simply fronts to defraud the silver investor. If these banks are put to task on their COMEX shorts and they are asked to deliver in size, they are going to satisfy those requests by essentially robbing the ETFs that they are custodian of. And that would worry me greatly if I was a sizable ETF holder. What can we do about it? Well, we carry out the Silversqueeze play. We put the COMEX shorts to the contract that they have entered into the marketplace with. They're net short around 60,000 contracts, according to the CME COT report. I make that around 300 million ounces, and that's just the 4 largest short positions. I'll clarify that when I talk about these ETF custodians, I don't include the Sprott PSLV, because of course they are not one of the big COMEX shorts. I own PSLV, and I believe they are true to the word of their prospectus, and that they are removing the 1,000 ounce bars from this hypothecation scheme that seems to be going on with the other banks that are involved in silver. Keep buying physical. we drain the real silver supply from the banks, and we see how long they can last selling silver at in and around $27.